Every major financial scam of the 21st century explained. Enron 2001. Enron started as a traditional pipeline company but reinvented itself in the 1990s as a global energy trading giant. On paper, it appeared unstoppable, posting record profits year after year. Behind the scenes, however, its success was built on accounting tricks and financial engineering that concealed billions in losses. The most critical tool Enron used was mark-to-market accounting. This allowed the company to record potential future profits from contracts as if they had already been earned. A long-term deal signed in 2000 could immediately be booked as revenue, even if no money was received for years. This gave the illusion of steady profitability. To keep growing this illusion, Enron built hundreds of special-purpose entities, SPEs. These shell companies were used to shift debt and failing assets off Enron's balance sheet. While meant to spread risk legally, Enron executives abused them to hide losses while still secretly controlling the entities. By 2001, analysts and journalists began questioning Enron's opaque financial reports. Once confidence eroded, the house of cards collapsed quickly. The stock price plunged from over $90 to under $1, eliminating $74 billion in shareholder value. More than 20,000 employees lost jobs and retirement savings. The fallout also destroyed Arthur Andersen, Enron's auditor, when it was revealed they had shredded evidence. In response, the U.S. government passed the Sarbanes-Oxley Act of 2002, creating stricter corporate reporting rules. Enron became the textbook example of how unchecked executive ambition, weak oversight, and complex accounting fraud can bring down a corporate empire. WorldCom, 2002. Barely a year after Enron's collapse, WorldCom, the second-largest long-distance telecommunications company in the U.S., unraveled in an equally dramatic scandal. The company appeared to be thriving, but its profits were the product of systematic accounting fraud. Executives, led by CEO Bernie Ebbers, reclassified routine operating expenses, such as network maintenance and repair costs, as capital investments. By doing so, they spread billions of dollars of everyday expenses over many years. This accounting trick transformed losses into apparent profits, misleading investors into believing WorldCom was financially sound. Over several years, WorldCom's books were inflated by more than $11 billion, making it the largest accounting fraud in U.S. history at the time. Investors lost more than $180 billion in value as the company's stock collapsed. In 2002, WorldCom filed for what was then the largest bankruptcy in American history, surpassing Enron. The scandal had a devastating human cost. Around 30,000 employees lost their jobs, and countless workers lost retirement savings tied to company stock. Ebbers was convicted of fraud and conspiracy, receiving a 25-year prison sentence. Notably, the fraud came to light thanks to the diligence of an internal auditor who stumbled upon irregularities. This showed how, despite its size, WorldCom was brought down by one person, following through on anomalies others ignored. If you're finding this breakdown useful so far, make sure to like this video and subscribe. That way, you won't miss the next deep dives into the world of finance and fraud. Bernie Madoff's Ponzi scheme, 2008. In 2008, the collapse of Bernie Madoff's investment empire revealed the largest Ponzi scheme in history, valued at nearly $65 billion. Madoff promised investors steady returns of 10 to 12% annually, regardless of market conditions. Wealthy individuals, charities, and institutions trusted him because of his reputation as a former NASDAQ chairman. The scheme was built on affinity fraud, exploiting personal and community connections, particularly within Jewish philanthropic networks. Instead of investing client funds, Madoff used money from new investors to pay earlier ones, creating the illusion of consistent performance. The scam persisted for almost 30 years, despite repeated warnings from whistleblower Harry Markopolos, who submitted detailed evidence to the SEC as early as 2000. Regulators failed to act until the 2008 financial crisis triggered mass withdrawal requests. Unable to cover them, Madoff confessed to the fraud. The fallout devastated thousands of lives. Families lost life savings, charities collapsed, and the ripple effects spread globally. The psychological toll was equally severe. Madoff's elder son, Mark, died by suicide in 2010, while his younger son, Andrew, died of cancer in 2014. Madoff himself was sentenced to 150 years in prison and died there in 2021. Madoff's case remains a stark lesson in the dangers of unrealistic promises, complacent regulators, and the power of misplaced trust. Subprime mortgage crisis, 2007 to 2008. The subprime mortgage crisis wasn't one scam, but a web of interconnected fraud and reckless behavior that almost destroyed the global economy. Banks issued mortgages to borrowers with poor credit and limited income, loans many had no realistic chance of repaying. These risky loans were then bundled into mortgage-backed securities (MBS) and sold to investors worldwide. Credit rating agencies like Moody's and Standard & Poor's gave these securities AAA ratings, implying they were as safe as U.S. government bonds. The agencies were paid by the banks creating the products, creating a conflict of interest. Investors from pension funds to foreign governments poured in money, unaware they were buying toxic assets. Meanwhile, predatory lenders pushed deceptive loans with low initial teaser rates that later reset to unaffordable levels. Lower income and minority communities were disproportionately targeted, and many borrowers didn't fully understand the risks buried in the fine print. When housing prices stopped rising in 2006 to 2007, defaults surged. The value of mortgage-backed securities collapsed, bankrupting financial giants like Lehman Brothers. The crisis wiped out $10 trillion in U.S. housing wealth and caused millions of foreclosures worldwide. Governments responded with bailouts, arguing many banks were too big to fail. Yet very few executives faced prosecution. Public anger exploded as taxpayers funded rescues while ordinary families lost homes. The scandal was later dramatized in the Oscar-winning film The Big Short, which showed how a handful of investors recognized the fraud early and profited by betting against the housing market. Stanford Financial Group, 2009. Shortly after Madoff, another colossal Ponzi scheme emerged, the Stanford Financial Group, run by Alan Stanford. He promised safe, high-yield returns on certificates of deposit, CDs, issued by his bank in Antigua. In reality, it was a $7 billion fraud that diverted client money into his personal empire. Unlike Madoff, who often targeted the wealthy, Stanford's scheme ensnared retirees and middle-class investors searching for reliable returns. Victims spanned the U.S., Latin America, and the Caribbean. The money financed Stanford's extravagant lifestyle of private jets, yachts, luxury real estate, and even a professional cricket team. Regulators had suspicions for over a decade. The SEC received warnings as early as 1997, but failed to act until 2009. By then, the scheme had already devastated thousands of investors. Stanford was convicted of fraud and sentenced to 110 years in prison, yet most victims recovered only a fraction of their savings, often pennies on the dollar. The case highlighted how slow regulatory action can allow fraud to fester, multiplying the eventual human and financial cost. Wells Fargo account fraud, 2016. The Wells Fargo scandal revealed how fraud can emerge inside respected institutions. For years, management pressured employees to hit aggressive sales quotas, pushing the mantra that every customer should hold at least 8 accounts. They called it the Great Initiative. Unable to meet these unrealistic targets, employees created over 3.5 million fake accounts between 2002 and 2016. Customers were charged fees for accounts they never authorized, saw their credit scores damaged, and in some cases faced debt collection over accounts they didn't even know existed. Whistleblowers who reported the misconduct were punished, often fired or demoted. The culture of fear ensured the fraud persisted for years before regulators intervened. When exposed, Wells Fargo paid $3 billion in fines and settlements. Its CEO was forced to resign, and congressional hearings made the scandal a national spectacle. The damage went beyond financial penalties. Wells Fargo's reputation as a trusted American bank collapsed. For ordinary people, the scandal was a reminder that fraud can occur within the very institutions meant to safeguard their money. Martin Shkreli and drug pricing, 2015. Martin Shkreli, known as the Pharma Bro, became a symbol of corporate greed in 2015. His company, Turing Pharmaceuticals, acquired the rights to Daraprim, a decades-old drug essential for treating toxoplasmosis, a dangerous infection for people with weakened immune systems. After acquiring it, Shkreli raised the price per pill from $13.50 to $750 overnight, a more than 5,000% increase. The drug cost only about $1 to manufacture, and no alternatives were available. Patients and hospitals had no choice but to pay. What stunned the public was that this was entirely legal under U.S. law. Shkreli had exploited regulatory loopholes that allowed price hikes on off-patent drugs with little competition. The case exposed how pharmaceutical companies could manipulate markets at the expense of vulnerable patients. Shkreli was later sentenced to 7 years in prison, but not for the drug pricing scandal. His conviction stemmed from securities fraud related to misleading investors in his hedge funds. The Daraprim case, though legal, showed how ethical breaches can be just as damaging as illegal ones, forcing regulators to confront the flaws of America's drug pricing system. One MDB scandal, Malaysia, 2009 to 2015. The One Malaysia Development Berhad, 1MDB fund, was established to promote Malaysia's economic development. Instead, billions of dollars were siphoned off by Prime Minister Najib Razak and his associates for personal use. At least $4.5 billion was stolen, funding lavish real estate purchases, a $250 million yacht, jewelry, fine art, and even the Hollywood production of The Wolf of Wall Street. The scandal revealed shocking complicity from global banks, most notably Goldman Sachs, which helped raise billions for the fund and earned nearly $600 million in fees. Goldman later paid close to $3 billion in penalties for its role. Investigative journalists and whistleblowers pieced together the fraud by tracing suspicious money flows. Public outrage grew as Razak's stepson flaunted wealth in Hollywood circles. Eventually, Razak was sentenced to 12 years in prison. Malaysia is still working to recover stolen assets, much of which remains hidden in offshore accounts. The scandal exposed how political corruption, weak oversight, and global banking networks can combine to enable financial crimes on a massive scale. Theranos and Elizabeth Holmes, 2015. Theranos, founded by Elizabeth Holmes, promised to revolutionize medicine with a device that could run hundreds of blood tests from a single finger prick. At its peak, the company was valued at $9 billion, and Holmes was celebrated as a visionary entrepreneur. But the technology didn't work. Theranos raised over $700 million from investors while secretly relying on traditional lab machines for most tests. Patients received dangerously inaccurate results, sometimes affecting life and death medical decisions. Holmes and her partner Sunny Balwani silenced whistleblowers with intimidation and lawsuits. The truth came out only after the Wall Street Journal's 2015 investigation by John Carreyrou. In 2022, Holmes was sentenced to over 11 years in prison, while Balwani received nearly 13. Beyond the financial fraud, Theranos endangered public health by distributing false medical data. The scandal remains a warning of what happens when Silicon Valley hype outruns science and oversight. Wirecard, 2020. Wirecard was hailed as Germany's fintech champion, worth over 24 billion euros and part of the country's prestigious DAX 30 index. It claimed to handle billions in online payments worldwide. In 2020, auditors discovered that 1.9 billion euros in cash reserves simply didn't exist. For years, critics and journalists at the Financial Times raised red flags, but German regulators targeted the reporters rather than the company, accusing them of manipulation. Meanwhile, auditors Ernst & Young signed off on Wirecard's books for a decade without detecting fraud. When the truth came out, Wirecard collapsed overnight. CEO Marcus Braun was arrested, while COO John Marsalek vanished and is still believed to be hiding abroad. The scandal shocked Germany and undermined trust in European regulators, proving that even advanced economies aren't immune to large-scale fraud when oversight fails. Archegos Capital Management, 2021. Unlike traditional scams, Archegos Capital Management, run by Bill Huang, collapsed because of reckless risk-taking and a lack of transparency. Operating as a family office, Archegos was exempt from hedge fund reporting rules, allowing it to hide its massive leveraged bets. Huang used total return swaps to take huge positions in a handful of stocks without disclosing them publicly. Banks that lent him billions couldn't see his exposure across the system. When those stocks began to fall, Archegos couldn't meet margin calls, triggering a rapid-fire sale. In just days, more than $20 billion in value evaporated. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion, and several other banks faced massive write-downs. The collapse directly weakened Credit Suisse, which itself collapsed in 2023. Archegos showed how a single, lightly regulated firm could destabilize global banks, exposing regulatory blind spots around family offices and derivatives markets. FTX and Sam Bankman-Fried, 2022. Finally, the collapse of FTX became the Enron of crypto. Once valued at $32 billion, FTX was promoted as a safe, innovative exchange by founder Sam Bankman-Fried, SBF. Behind the image, FTX was transferring billions in customer deposits to its sister firm, Alameda Research, to cover risky bets and trading losses. Funds were also spent on luxury real estate and political donations. Customers believed their deposits were secure, but the money was already gone. In November 2022, a leaked balance sheet exposed the weakness. When rival exchange Binance announced it would sell its holdings of FTT's token, FTT, panic ensued. Within days, FTX collapsed, owing customers over $8 billion. Bankman-Fried was arrested and extradited to the U.S. to face fraud, conspiracy, and money laundering charges. Executives at Alameda pleaded guilty and cooperated with investigators. The FTX implosion destroyed trust in cryptocurrency exchanges and proved that, without oversight, even the most celebrated platforms can be vehicles for massive fraud. If you've made it this far, hit subscribe and turn on notifications. We'll keep exposing how money, power, and deception collide in the biggest financial stories of our time.